We're here in Monte Carlo for the Rendez-Vous de Septembre. For Best TV, I'm Richard Banks. I'm joined now by David Flandro, Head of Industry Analysis and Strategic Advisory at Howden Re. David, it's good to have you back with us.
Well, thank you for having me back, Richard.
So, David, we're more or less at the halfway point of Monte Carlo, perhaps a little bit past it, but how has your analysis evolved over the course of the event so far?
Well, that's an interesting question. And I guess the analysis that I would have is that people are beginning to see opportunity in the market. Everybody was quite tentative coming in. I mean, for a number of reasons. Risk premia are heightened. Reinsurers have shared a big part of the California wildfire loss. We have casualty reserves. We have higher interest rates. And so there's a lot to worry about. But I think that at least in the conversations I've been having, cedents and markets are now focusing on this unique point where we are in the cycle and focusing on the opportunities.
So when you say opportunities, what sort of things are we talking about?
Well, economic value creation. So if you look closely at the shape of the cycle, if you will, I was just actually speaking to someone who told me once that you'll spend 1 year in a hard market for every 7 years that you spend in a soft market. I think empirically that's about right. And it's notable that from 2022, we've had a really hard market, actually. And in fact, detachment points have gone up. Pricing has gone up, dedicated capital went down, inflows were slow. But what that means is that accident years 23 and 24 were very profitable for reinsurers, particularly in the nat cat market, but also mostly elsewhere. So we are starting to see investment capital come in, but pricing is now past the crest. And I think what people are realizing is that even though pricing is past the peak in absolute terms compared to where we were 5 or 6 years ago, there's still plenty of margin in there. And you can actually measure that using economic value creation metrics. And so I think what I'm seeing, which to my happiness, is that we're seeing cedents and markets coming to the table, having interesting discussions and really renewing that partnership.
So you've seen market cycles turn before. Bearing in mind where we are now, what do you expect to happen next?
Well, this is the question that everyone's asking, and I think that the answer is quite obvious. We've now had 3 or 4 renewals where, we've been down 5 to 10 or something like that. You could look at 1-1 or 1-4, 1-6, 1-7. If we have a normal rest of the year, as it were, it won't be any surprise at all to see that happen again. The more interesting question, though, really is about, if you're trying to plan, what happens in the next 3 or 5 years. And then you have to start looking for analogs. And there are no perfect analogs, but you can see that there are these periods of peak profitability in the cycle. The last one was really in the 2006, 2007, 2008 era. And if you remember that, we, of course, had Charlie, Ivan, Jean, Francine, Katrina, Rita, Wilma, and then we had the financial crisis. We had heightened risk premia. If you remember, there was a lot of pessimism in the market then about catastrophes, about liability, but with hindsight, we know that was the most profitable period. What have we had now? Well, we had Hurricane Ian, we had that big interest rate spike, we had dedicated capital drop, and then we had rates go up. We're in a world of heightened risk premia again. In the country where I believe we both live, you've got the long end of the curve possibly approaching 6%, which is quite daunting, right? You've got medium duration interest rates going up, quite high as well. And what that does is it creates hurdle returns, both for ILS investors, for reinsurers, for everybody. So even though we're coming off that pricing peak, the question I have is there a floor somewhere? Is there a plateau like the one that we had in the late 2000s? I don't know, but I don't imagine that we're going to get all the way back to 2018 anytime soon. And so underwriters are thinking about their books in that context, and I think it's right to do so.
And in terms of where we are in the cycle, does that affect cedents' purchasing of reinsurance? Do they purchase for different purposes? Are they buying it for the same purposes?
Well, actually, cedents are very hungry for reinsurer capital right now because, in fact, the cost of equity and the cost of debt have both gone up by quite a lot. We were just talking about the cost of debt. So in that environment, there is, and I'm sorry to geek out a little bit here, but there is a Modigliani-Miller optimum in terms of optimizing your weighted average cost of capital. And reinsurance is part of that optimum. So you're right. Cedents will be buying differently now in this interest rate environment and in this cost of capital environment than perhaps they would have, 5 years ago or even a couple of years ago. But in terms of nat cat, particularly, because this is what our report is about, who dares wins. In terms of nat cat, reinsurers basically had, very good terms and conditions for the last couple of years. Typically, insurers retain about 54% of all on-leveled modeled exposed losses. That got all the way up to 67% in 23 and 24. So I know that insurers want to get that back down something closer to normal if they can.
Can I ask you a couple of more general questions?
Of course.
David. We're here in
Yeah.
Monte Carlo, and conversations tend to sort of coalesce around particular topics. And one that we've seen a lot of is the use of AI in insurance and
Yeah.
reinsurance. Do you have a sense as to the application of AI in insurance and reinsurance? You obviously steeped in data. Maybe there's applications there. Maybe there are challenges there.
Well, you're onto something. I think right now the whole world is using AI. I mean, we all have it on our phones now. It's on our laptops, and you can even talk to it, right?
Yeah.
It's really going to be transformative. But is it a differentiator for you as a broker or a reinsurer or an investor or a buyer? And the answer is only if you have a unique data set that you alone can query. AI is amazing, but you can only use it to differentiate if you have proprietary data that's homogenized, that's structured, and that is unique. If you can achieve that, AI becomes extremely powerful, and that's why Howden's enterprise business intelligence tool, Nova, is really quite a great place to begin.
So, David, one final question, if I may. Is there one topic today that's being missed that will be really important in the future?
We're all talking about casualty reserves. We're all talking about secondary perils or so-called secondary perils or frequency perils or whatever we're going to call them now. We're all talking about rates being off 5 to 10%. Remember, in the insurance and reinsurance sector, the thing that really drives the cycle is interest rates, inflation, and capital. So keep your eye on interest rates, inflation, and capital. The last price spike wasn't due to Hurricane Ian. It was due to the interest rate and the capital impairment that took place in 2022. So if you want to look at something that not enough people are talking about, I would say that's it.
David, it's always fascinating to talk to you. Thanks so much for your time.
My pleasure.
For Invest TV, I'm Richard Banks.